So the bigger the dispersion, the greater the chance for outperformance. And the S&P committee, their analytical edge is 4/4 of net income that's positive. And nobody can outperform these people. Amazon at the bottom, I think it was 850 billion market cap. If they ran at that steady state, I think you already had 84 billion of free cash flow, and divide that by 850 billion market cap. When we bought Amazon in December of 2022, that's a 10% free cash flow yield. Yes, financial media headlines, they love to grab investors' attention. But generally speaking, the secular bull market has run for about 15, 16 years. Of course, the market is more expensive and more risky now than it was. Napoleon Bonaparte famously said it, ability is nothing without opportunity. And I love that quote. So what is an attractive opportunity, or what is an easy game?
Next to the chart of Buffett's cash position, I included a chart of the Shiller PE ratio, and that's another metric that receives a lot of media headlines, public commentary. And
yes, and I used to follow that quite a lot back in my day, in the early days. I had to unlearn some of these things.
Yeah, good point. And I feel like there's almost consensus nowadays that the S&P is indeed trading at high valuations. However, something that you have been quite vocal about on Twitter is that you can't compare the S&P today to the S&P, say, 40, 50 years ago. And I included this tweet here from you here on a slide. And I'm not sure if you read a blog post that I wrote on that subject myself, in which I brought up a similar point. But the question I want to ask you here is the S&P really overvalued right now? Because I think you and I would agree that the S&P today is a higher quality index than it was 40, 50 years ago, just because revenues are more recurring, businesses are earning higher margins, businesses are more diversified from a geographic point of view. What's your point on or take on this?
Yeah, I mean,
is the S&P really overvalued?
Well, overvalued.
And let me just say to you, sorry for interrupting you here.
Sure.
In a way, you answered it already by highlighting that it really depends on your time frame.
Yes, but we covered that point. We'll get into another point now. So we should keep that point in mind. Don't neglect that previous section that we discussed. If you have a very long time horizon, overvalue doesn't mean anything. If you believe in the strength, the corporate excellence of the United States, and that the economy will continue to do well over the next 20 to 30 years. And Buffett has frequently stated that he is very bullish on America. So take that for what it's worth. But yes, financial media headlines, they love to grab investors' attention. That's known as salience bias, right? You get one red tulip to stick out from all the yellow ones. It really has this contrasting effect, and it entices, to use that metaphor, it entices fear among investors, and loss aversion and salience bias are working in tandem. They're two psychological biases. But you really have to dig under the surface, and you have to really figure out, you have to ask some very important questions about the accuracy of these traditional valuation multiples like CAPE or enterprise value to EBITDA or price to book and so forth. I think if I can answer this, I will answer it in two sections. First of all, making a distinction between tangible and intangible investments, and then thinking about the data from a stationary and non-stationary point of view. So if you just give me a little bit of time. So first of all, tangible versus intangible investments. Well, the concept here really is that there are two ways that a business can lose money. The traditional way, which we all know, which is that expenses exceed revenues, and then you're really losing money and you're in trouble. But then there is a modern way, right? And this comes down to outdated accounting standards, which we'll cover in a second. But the modern way is where intangible investments are expensed on the P&L statement, on the income statement, and they create a bit of an artificial loss, or at least if you're not losing money. Some companies look like they're losing money, but they're not, because they're investing heavily. But other companies have artificially subdued or lowered earnings. And if you rely on these multiples, you will get into trouble. That's why valuation, that's only one of the reasons why valuation multiples are not valuation work. In reality, if we were to amortize intangible investments the way that capital expenditures are capitalized on the balance sheet, then the business in question or the index in question could potentially look different or be more profitable. The issue is that accountants expense intangible assets. And what are intangible assets? Just really quickly, things like R&D and sales and marketing costs and so forth, some tech investments and things like that. They are expensed on the income statement, and they're not placed on the balance sheet by capitalizing them, or correct word is amortizing them. And this is an outdated accounting rule from the, I think, the early 1970s. Back then, the economy looked very different, Renee, to the way that it looks now. The global economy today has become much more reliant on intangible assets. It's really paramount to make a distinction between these two to gauge whether a company, is truly profitable or not, and whether it's running an asset-light or a capital-light business model, and what its earnings are and return on capital, and therefore what it's really trading at. So 1970s, computer boom was just starting, and the R&D research was kind of viewed as a very uncertain expense that might not produce anything. So it's better to just expense it over a 12-month period on an income statement and not capitalize it as a true asset on a balance sheet. And so now there are these enormous amount of investments, and I'll quantify it in a second. But there are these enormous amounts of investments that are basically, they're treated as if they're expenses, and they're having a meaningful impact, especially in the US, which is tech-dominant index. And by the way, I think French and Farmer published a report in the late 1990s or 2000 or something that value beats growth. And just around the time that became the go-to article for all the quants around the world in the investing world, it was actually the time when intangible assets and growth companies, their intangible investments exploded. So intangible investments was something like 600 plus billion, and capital expenditures were also 600 plus billion in 2001. But in 2021, in other words, 2 decades later, intangible investments were over 2.1 trillion, and I think capex was only 1 trillion. And I think by 2024 now, we're probably at 2.5, especially with the massive boom that's going on. Like people say there's a very big capex boom by the Magnificent Seven. Yeah, you should see their R&D boom. It's even bigger than their capex boom. And so, I think there's a whole group of investors that are, including the financial media, which are not investors, that are just neglecting this whole aspect. And just to give you a takeaway from all this, great investors are capable of differentiating between expenses and investments. They know that today's cost is different to expenses. The investments that are cost today can generate tomorrow's profits. And so they're very good at sorting expenses that are necessary to run the business away from those that are investments that happen to be expensed on the P&L statement that are potentially can generate future cash flows. And these analysts or great investors are then capable of amortizing them, at least for themselves, and on the balance sheet instead of expensing on P&L to get to the true earnings power. And I mean, when we were doing that for Amazon, just on the top of my head now, we thought that, Amazon breaks down their R&D, which is really, really good. And we thought Amazon at the bottom, I think it was 850 billion market cap. And I thought that if I adjusted the intangible investments by a certain conservative portion, that Amazon's free cash flow yield was 7.5% to 8%. That's what I estimated. If it just recovers back to where it should be during that inflation period. But the fact that it's grown more, and they're investing even more into capex now, and they're investing even more than capex into R&D, probably says that I was too conservative and I was probably buying the company in 10% free cash flow yield. I'm talking about yield on cost, not back then, like 800. And I mean, I think Amazon can easily get to 84 billion free cash flow even today if they were to cut their capex to just maintenance and not growth, and if they were to really decline their R&D. If they ran at that steady state, I think you already have 84 billion of free cash flow, and divide that by 850 billion market cap, where we bought Amazon in December of 2022. That's a 10% free cash flow yield, a yield on cost that we paid. And that kind of shows you how a growth company becomes a value company, a value investment, I should say. So that's a really big portion. And then the other one, just really quickly, without going too far, is comparing today's earnings to those of past decades. It really shows investors' inability to distinguish between what's stationary systems and stationary statistical data points versus the non-stationary ones. To correctly compare today to the past, the statistical properties in the underlying subject or system should remain the same, okay? So earnings aren't the same due to the rise of intangibles, and also the index earnings aren't the same because of many of the companies like Codex of the past and the GEs have been removed from the index, and many, many others like Enron's. And then today's companies look far different. And you have there on a slide, a chart that I used, today's companies are of higher quality. Now, I'm not disputing that the S&P is not expensive. I don't know how expensive, and I don't know what somebody's time horizon is. But all I'm trying to say is that a great statistician or a statistical professor would tell me and mentor me to say that, Tiho, the world has changed, but you're still using the same tools and metrics as if it hasn't, right? And that's what a great statistical book has taught me, to think, and I borrowed that from statistics to become a better investor. So stock markets are non-stationary systems that are always in a state of flux and change. And I think comparing previous cycles to the current one is folly. You know, I don't think it's very useful because the statistical underlying properties are changing within that index. And the free cash flow margin in that slide is just one of many examples that we can talk about. So that's my answer to that. So
that was fantastic.
Is the stock market expensive? Probably, because it was, if we can just say in layman's terms, simpleton English, it was cheap in 2009 and it's rallied up a lot, and valuation multiples have increased. But we have to be careful because valuation multiples don't tell us about intangibles and the quality of earnings or any of those kind of things. But generally speaking, the secular bull market has run for about 15, 16 years. Of course, the market is more expensive and more risky now than it was a long time ago, 10, 15 years ago. And the future expected return will be lower, depending on your time horizon. But how expensive and whether we should use the CAPE ratio to tell us that it's same as 1929 or 2000, I think that's dangerous territory and quite fallacious.
Yeah. Let me just add one comment here. So I think there are more and more voices nowadays that are demanding that the accounting standards have to change to reflect the modern world of business. As an individual investor, I'm actually rooting for the accounting standards remaining the same because I feel like it can give me an edge. Because if I'm able to differentiate between the true reinvestment requirements of a business just to stay in business and those that are supposed to fuel future growth, this can offer me to find opportunities, like you mentioned Amazon as one example, that others might not be able to find. And oftentimes this would require you actually listening to earnings calls and maybe even talking to management. And that's not what your competition will talk about.
Some actual work, doing a lot of hard work.
Yeah, exactly. That's what most people shy away from. Okay, I have two more subjects to address here. So I decided to include another tweet here in which you talk about a lot of things. So just now we were, for example, talking about competition. And I think you tweeted this not too long ago, and you basically highlighted that you should try to compete in fields, and if we talk about stocks, I guess, invest in markets or sectors where there isn't a lot of competition, or if there's competition, your competition is very weak. So
Yes.
I wanted to ask you, what's your practical takeaway from this general take here? Where do you think you should invest nowadays? Because arguably the US is certainly a market where there's a lot of competition. Whether it's strong or weak competition, I guess that's another question. You like if I may connect this to another point you just brought up. You mentioned that you invested in a small cap index. I think it was not too long ago. So I think the small cap space is generally also known for being an area where many institutional investors cannot go quote unquote fishing. Where do you think people find the least amount of competition nowadays in markets?
Well, let me try to give some theory behind this as the way that I understand it so I can answer the question properly as opposed to just starting to answer the question.
Yeah.
So when it comes to achieving results in life, in entrepreneurship and business or investing, I think most people allude to the fact that you can do something really well if you have skill or an edge. But the algorithm or the formula is that success in life or excess return in investing is equal to skill and luck in brackets multiplied by the opportunity set. Okay, so I think people incorrectly think that all one needs to achieve success in life or success in investing is skill or proficiency. But you also need to have a very attractive playing field. And that's something that many people either don't understand, or if they do, they sort of kind of pass by it and disregard it. Napoleon Bonaparte famously said it, ability is nothing without opportunity. And I love that quote. So what is an attractive opportunity, or what is an easy game? And I like to use a poker analogy. Poker analogy really explains it. Instead of trying to become a better player at the game so you can one day make it to the World Poker Championships. And by the way, I don't play poker, I don't gamble. But the takeaway is that one should place a lion's share of their time finding easy poker games against suckers. Okay? Why would you go and try to become better when you already have the skills? And the goal here is to actually just play against easier players. So,
if I may just really quickly provide one example here. I'm thinking of Dan Bilzerian here, for example, who I think if you would ask any professional player, he doesn't possess any superior poker skills. But there's certainly the question whether you can trust his numbers, but he himself claims that he has made many millions by playing live poker. And I think that can partly be attributed to him playing in games where the competition was just very weak.
Exactly. So the fancy analogy, well, the plain English is that you're either playing games with little to no competition, where the market is underserved or something along those lines, or if there is a lot of competition, there is weak competition. And the fancy terminology for that is that there's a dispersion in skill between really good players, let's call them strong players, and weak players. A wide dispersion in skill in some domain or avenue or field between the strong and weak competitors in a chosen task helps the competent players generate alpha from incompetent players. Active investing is a zero-sum game. Index passive investing is not. But your alpha has to come from your competition. So the main lesson, I think the main takeaway is that it's far more important to worry about the game that you're playing and the conditions that you're in than only just the skill that you bring to the table. And if you don't believe me, it should be no surprise to once again quote Mr. Warren Buffett, the GOAT, greatest of all time, who said that the secret of life is having weak competition. And Charlie Munger's quote, which is more direct and more funny, he said, you have to look for a special area of competency. So he's talking about staying within your circle of competence. And then he said, in his own ironic, funny way, go where there's a lot of dumb people. And I think that makes a lot of sense. And so the equation, once again, is skill multiplied the opportunity set. And so if we do agree that the way to express our skill is through market timing, superior selection, or mispriced opportunities, and position sizing, those are the three ways that we covered that an investor can express their skill. The question is, when do active investors perform through this, perhaps the most important edge that everyone's focused on, which is superior selection? Well, there are three conditions, Renee. If I may, I'll explain to them. So commonly, superior selection is referred to, that process is referred to as stock picking or bottom-up investing. And we all think that we are going to be able to do it, but actually there are certain conditions in place, fundamental conditions that need to be displayed in an index, whichever, or your watch list. And when those when that watch list of stocks displays these three conditions, or when that index displays these three conditions, then the active managers or active investors have a much higher chance of outperforming. The first one is that individual stock return dispersion has to be wide. Okay, so what does that mean in plain English? Well, dispersion is the range, right? You have the median, so you have the S&P return of the index, but then you have the lowest stock and the highest stock performance, and then you have a dispersion is the range in returns given a certain group of stocks or an index or a watch list. So it's stating it in another way would be the degree of variation in returns between all of the index's components under the hood, or how differently individual parts of an index or of your watch list perform in parts relative to the whole, right? Wall Street will sometimes say an adage. They will say, we are in a stock picker's market. That's just fancy lingo for saying there's a wide dispersion of returns. So here's the takeaway. Wider dispersion tends to increase potential for higher returns, and of course, vice versa. So without a wide dispersion in returns, even the most capable active investors like yourself, who are very skillful at mastering the art of finding mispriced assets and only making a bet on them at the right time, they still face constraints, or even they will be unlikely to outperform. So perhaps I can use an analogy to explain why. Let's assume there are two groups of stocks or watch lists, or two identical indexes, right? And let's call them a boring index or boring watch list and an exciting one. And they both have an average market capitalization return of 10% for that year. But the first index has a low dispersion of returns, and let's call it the boring group, right? The best performing stock did 12%, and the worst one did 8%, and the rest fell into that, and the average was 10%. It's hard to build a portfolio that's going to get you 20% return on investment, or anything better than close to what the index itself did, irrespective of your superior selection, which is one of your skills, or how you size that selection, which is position sizing, which is the other way of expressing skills. So unless the opportunity setup is right and you've selected a wide dispersion of stocks, doesn't matter how good you are at selecting stocks, which is your superior selection process, or how good you are at sizing and building and constructing your portfolio. If the conditions are not there, or opportunity set is not there, remember, skill multiplied by opportunity equals excess returns. Now consider the other index, which is high dispersion index. This is like an exciting group. Here you have best performing stocks. A couple of them do a multi-bagger that year. And I think for both of us, it was Meta over the period of 2023. On the other hand, a couple of them go bust, and the rest fall in between of that massive range. Here is truly, this creates a fertile ground where active investors can truly differentiate themselves if they can display proficiency or express their skill via both superior selection and of mispricing bets and position sizing them correctly. If you pick more of the good quality stocks that go up a lot and they have enormous payoff, and you size them appropriately and adequately versus the ones that go to zero, then you can really shine as an active investor. So, so that's one of the conditions. The other one is that individual capitalization of the index has to exhibit a diversified market instead of a concentrated one. So we just talked about dispersion, and that's one way to measure skill of an active investor, or an opportunity set that's attractive for an active investor to outperform in. The other one is the market diversity. When there is a large percentage of market cap, as it is currently right now with the Mag 7, that's in a handful, right, of stocks, which is just 7 of them, the market diversity is low, meaning the concentration is high. So market diversity asks an important question. How evenly is the market cap of every company distributed across the index? Are we working in conditions which exhibit diversified or a concentrated index? And the obvious takeaway here for anyone listening is that when you have a falling market diversity or increasing concentration, that creates a massive headwind for active investors because their opportunity set narrows. Unless you own Meta, Amazon, and Google, as we did, and Booking last year, we outperformed the index. But I think it was one of the lowest percentage of active managers that outperformed the index in many, many years.
Yeah, and if I may just throw in a number
Sure.
here real quick, which I discussed with Andrew 2 days ago, I shared a slide that
Sure.
I'm not sure where I found it, but it showed the percentage of S&P members actually outperforming the market in that given year over time. And the last 2 years have been the years where that percentage has been the lowest. I think was 29% in 2024 and 28% in 2023, which shows the point that you are just making. If the largest constituents are doing so well, and they represent the majority of the index, it just becomes very hard to outperform the index without owning them, right?
And without only owning them.
Yeah.
Yeah, because if you own them together with the rest of the stuff, then you're going to perform like the index. But if you own only them without the rest of the stuff, then that's when you actually can outperform the index.
Yeah.
Just as a rough guide. And by the way, that percentage of members outperforming the index is the lowest since 1999 and 1998. Which was the last time the bubble peaked. And so Warren Buffett will probably say intuitively, I've seen this rodeo before. This is not my first rodeo. I've seen this movie before. And so we're linking market timing and intuition and great expertise with each other. But that's the problem. So, and then the final condition is that active investors and active fund managers, they tend to outperform when the index is actually struggling, believe it or not. So if I was to ask you, over the last 50, 60 years, when did active managers and mutual fund managers and hedge fund guys perform the best? You'd probably say in the 90s or in the last 10 years when the market did the best. And the answer is actually no. Active fund managers outperformed the market in 1970s, which was a lost decade. And in the 2000s, 2000 to 2010, that's when the largest amount of active funds beat the market. And both of those decades were the lost decades where the S&P went sideways in nominal terms, but it significantly declined in inflation-adjusted terms. Conversely, the 80s and the 90s, which were like this incredible run for the stocks, which ended up in the roaring 90s, which was the greatest boom since the 1920s, the roaring 20s. The index did superbly well, but the lowest amount of active funds beat the market. So, I mean, what's the causality here? The crucial insight here is that active investors try to differentiate themselves at least a little bit through diversification from being too heavy in any single security. And they also tilt or have exposure, which is a fancy word, tilt. Right? They have exposure towards value and small cap factors. So if somebody has an S&P as a benchmark, they won't own the top companies that the S&P has, but instead what they'll do is they'll try to pick some smaller companies that can grow into a larger size, and they'll try to buy it at a cheaper point in time so they have a chance of outperforming. But the irony is that these factors, as quants call them, value and small cap factors, they underperform when large cap growth dominates, as was the case in 1990s, as is the case in 2010s. So to outperform the index right now is very, very difficult. But if the index enters a secular bear market, which perhaps is the overall topic of this conversation, if you do have skills or proficiency in finding mispriced securities, you should actually be able to outperform the market, and more active fund managers will outperform when the overall index lags. That's the takeaway. So just to summarize again, you need a wide dispersion of the group of stocks in your watch list or the index that you're tracking. You want to make sure that this individual capitalization is diversified. There's a big market diversity as opposed to concentration, because they limits the opportunity set. We're going through one of those periods now. None of these periods are everlasting. They are cyclical. But the final one is that when the conditions are poor for indexes and the index itself is struggling, active investors tend to find more ways, and more active investors, ironically, tend to outperform.
Awesome. Yeah, that was great. One of the takeaways from the chart I was just talking about, showing the percentage of S&P members outperforming, and that figure being at a low over the last 2 years, was also that in previous instances where this was the case, we often saw years where quite the opposite was the case, and we had a much higher percentage of stocks actually outperforming the S&P, which I think only makes sense, because I'm not sure if that's true with regard to the Magnificent Seven right now.
Well, but I'll share a chart with you if I may.
Okay, let me stop
everything that I just talked about, in particular, market diversity. So here we go. So I'll share a chart with you here, and this is what we're talking about, right? And so if you have a very big diversity in your watch list or a group of stocks or in the index itself, you have a much higher chance of outperforming the S&P, which is that yellow median or average return. So, there are investors I know. For example, I was looking at somebody's track record the other day. I think it was Monish Pabrai, and he did 110% in 2009. Okay, so he was up here somewhere.
Yeah.
Right? And if he selected even better stocks, right? And if you had the skill, you can express your skill. I'm not saying it's possible, but in theory, if you diversified less and concentrated into even better stocks, and you position size them correctly, which is two ways of expressing our skill as active investors, you could potentially push that even up to here. That was the limit. So the bigger the dispersion, the greater the chance for outperformance. And this is ironically what the market did. But then there are years where the dispersion is very narrow, and the top decile of stocks don't do that much better to the bottom decile of stocks. And then, I mean, this chart, I'm not sure how exactly it was constructed. It was from one of the quants that I found. But if you were to construct the chart in a different way, if you were to hold only 10 stocks as opposed to just a couple of them, then these bars would be even smaller, because nobody wants to just hold 3 stocks unless you're on Joel Greenblatt or Charlie Munger or something like that. Greenblatt, I should say. Yeah, so if you have 15 stocks in your portfolio, these bars will be smaller, and there's even lower range or dispersion of individual returns. And so that's what I wanted to put forward, because I think it's easier to visualize it than just the words.
Super helpful. What's amazing is that in 2008, even the top decile only delivered like break-even return.
Flat, or like a flat return or something. And that's if you had the God-given skill, right? A God-given skill of being able to pick only a handful of stocks that went flat. Probably like utilities and, I mean, I don't know, a couple of consumer names maybe that just sell like canned food, and a couple of companies that sell shotgun bullets, and that's about it. Yes. So there we go.
Hugh, are we still good on time? I have 2 more topics to address.
I have plenty of time, Renee. I enjoy our chat, so as long as you're good for it.
Perfect.
I mean, one of the things that I would like to cover, if you don't mind, is we talked a lot about the S&P 500, but we have to know what the S&P 500 is and whether we should invest into it or whether we shouldn't invest into it.
Yeah.
And whether we should
a little bit related to this tweet here.
Yes. Let me just have a look at that tweet.
So basically, I was just highlighting that as an active investor, I'm obviously looking for companies that match certain criteria, and I would argue that the majority of S&P members don't match them. And now I'm thinking of revenue growth, free cash flow per share growth, the return earned on reinvestments, having a healthy balance sheet, stuff like that. But I'm not sure where you wanted to go, so feel free to take it wherever you want.
I think a wonderful mental model for competing in a zero-sum game, which is what active investors are doing, is borrowing from sports team management, is to evaluate the strengths and weaknesses of all of your competition. And that's what they would call in baseball and in football and in soccer and in tennis a scouting report. Okay, so you go and perform a scouting report to figure out the competitors' weaknesses so you can either exploit them or mitigate against their strengths or clone their advantages. So you can do both.
Yeah.
So the question for investors, for anyone that's aspiring to be an active investor, because we kind of got the cart in front of the horse, we started talking about when to outperform as an active investor. But I think the question that comes even beforehand is, should you even try to be an active investor or should you index? And the scouting report really focuses on your competition so you can better understand that. If you break it down into first principles, there are only really two competitors, two different categories of competitors. First one is certain benchmarks or indexes, which are essentially your opportunity cost. If you're a tech investor, there might be NASDAQ. If you're a global investor, there might be the MSCI World Index, which is a fancy way of saying the global index fund. And if you're a US investor or in stocks only, there might be the S&P 500. I think the S&P 500 is perhaps the most widely recognized benchmark in the world of finance. And most people would agree that that's the opportunity cost for all investors. Effectively, it's the cost of our capital. You know, companies have a cost of capital, and they need to have an economic value creation. They need to have a return on their capital that exceeds it. And that excess return is what creates value to shareholders. Well, for us to create value for ourselves, we need to exceed that the S&P does. And so...
And by the way, the companies you own too, if they don't exceed that hurdle, that you yourself would be better off if they just distributed the money to you so you could invest it into the S&P.
Exactly, very well said. And so I think all active investors, irrespective of the size of your account or the skills level or the qualifications, I think qualifications are not important in this industry like they are in medicine or in airline industry where you have to be a qualified pilot. I think here, when you're a qualified fund manager, it's probably a bad sign. And the reason I bring that up is that, well, you're expected to outperform this benchmark, this opportunity cost, this cost of capital. And it's the only way that you can justify your profession, your active strategy, and your fees, which you are charging most likely. So if you can't outperform it, what's the point? And the historical data reveals that overwhelming amount of investors fail to do so over long periods, extended periods. I think it's 90% cannot
over 10 years,
over 10 years, and over 95% over 20 years. And so the benchmark is one of the scouting reports elements. The other factor that we need to do is are the fund managers that we are competing against. Because active investing, once again, is a zero-sum game. That means that one's alpha or excess return must come from the mistakes of your fellow market participants. They must make mistakes for you because everything must add up to a zero, a net sum of zero. A handful of people that have positive alpha must add up to a large amount of people that often have negative alpha, and those add up to zero. And so we need that's why Charlie Munger said, look for dumb competition, right? People laugh at his proverbs and silly quotes, but he was a very intelligent man. But here's the irony of it. We talked about analytical edge of finding something in Amazon, or you stating that you don't want the accounting rules to be updated because they'll give you an edge. Which I agree with, and I hope it doesn't. But I just want to add something here, which will kind of get us both thinking. I'd love to hear your comments. So we just figured out that 90% of active fund managers don't outperform their benchmark or cost of capital over 10 and 95% over 20-year period. So we have to carry out the scouting report and figure out what the S&P Standard & Poor's Committee uses as its criteria to select candidates. So the first one is jurisdiction. This is what they do, by the way, jurisdiction. All the companies must be US-based. Second one is the company type. All of them have to be common stock equity, so to speak. They can't be closed-ended funds like Bill Ackman's fund. They can't be ETFs, ADRs, pink sheets, foreign companies, and so forth. None of them can be included. The third thing that they do when they are filtering is liquidity. The stock has to have minimum liquidity, so it can be traded by fund managers. It can be easily tradable, right? So those are the three things. Then we have financial viability. So this is what S&P states on their website. S&P committee looks for positive earnings over the most recent quarter. And also, there must be an example, I'm just paraphrasing, off the top of my head here, most recent 4 quarters. So in other words, that's it. That's all of the analytical work, both quantitative and qualitative, that the S&P committee does. That's it. So you just imagine all these things that we are doing, me and you and many of our competitors, all the people on X and Twitter and other social media platforms and Reddit, and all of the Wall Street and the fund managers in London and Singapore and Dubai and so forth. Investors spend countless hours trying to uncover these insights that others hopefully have missed so they can get an edge. And 95% of these investors can't outperform the index. And the S&P committee, their analytical edge is 4 quarters of net income. That's positive.
Yeah.
And nobody can outperform these people. So what's the other stuff? Okay, eligibility of the market cap. The S&P committee says that candidates have to be in excess of some market cap. I think it was like recently, they constantly updated. It's like 14 billion now. So it has to be leading companies in those industries, and that's it. And then finally, something to do with sectors. You can't have too much weighting in one sector relative to the other, relative to the overall total market. So those sectors have to be within the weights. And now, so that's what they say that they do. I'm going to add a few things that they don't say that they also do. They don't do any macro forecasting. Zero. They don't sit around. You don't see like a table of S&P committee guys when they are bringing in S&P candidates or they're kicking them out. They're saying, well, I was looking at this indicator by these macro guys and they said that this and this was linking and correlating and there could be a recession tomorrow or Buffett is selling or something like that. No, they don't care about any of that. By the way, this is at the heart of a strategy that beats 95% of the smartest people in our industry. Yeah. People who are paid incredible amounts of money, and all they do is 4 quarters of profitability, no macro forecasting, certain market cap, certain liquidity, can't be a pink sheet or an ADR or an ETF. And also, what do? They practice long-term investing. They don't say that, but they leave it in the index for as long as it needs to stay there. They are unconstrained by valuations, which me and you said we focus on valuations. They don't care about position weighing, investment style. They'll let NVIDIA get to 20% if it has to. They don't cut and trim. They don't do any portfolio turnover. It's very, very low. They only kick out some members and add some members periodically. No forecasting of the economy or anything to do with analytical. They don't buy more when people are panicking, the market timing. They don't buy less. Isn't it mind-blowing that such a simpleton-like strategy beats almost everyone in our industry? And we are here talking about how we're going to try to get an edge, analytical edge or another form of edge. But these guys are beating everyone and they don't have any edge and they don't do anything.
Yeah.
So this is always mind-blowing to me. So that's a reason to own the S&P. But then there should also be, we should do the disconfirming evidence and we should look at the reasons or why not to invest into S&P. I mean, before we venture down a path of where we should invest, we should always consider subtractive thinking as opposed to additive thinking or pre-mortem analysis instead of a post-mortem analysis. Or Charlie Munger's inversion, right? Charlie Munger says, figure out the things that you want to avoid and then start there and then see what's left and do that. and psychological research shows that most human beings have a subtraction neglect. In other words, they only think from addition, what to buy, what to do. They don't think about what we should not do. So here are some following statistics. I think you've added some there as well in tweet, but I'll just add some. Yeah. I'll just pull it up here on my page that I prepared. Yeah. This is my scouting report on why not to own the S&P, or which parts of the S&P I should not own. 6.2% of the members in the utility sector, I don't want to own them. And I'll explain why in a second. 6.2% of the real estate sector, 5.5% of the material sector, 4.3% of the energy sector. I don't want to own them. I don't want to own 2.6% of the banking industry, which is in the finance sector. I also don't want to own the 4.6% of the index S&P members, which are in the insurance industry, which are in the finance sector. I don't want to own biotech industry, which is 1.6%, and 0.5% of the S&P is in the airline industry. I don't want to go anywhere near that. That's the worst of them all. So that's about 33% of the index that I'm going to subtract straight away. And I think the reasons are sound. Okay, now I'm doing more than the S&P, and the question is, if my analysis is good, I should be outperforming the S&P. And you've listed at the beginning that I've outperformed this so far. So far, so good. Fingers crossed I continue to do that. But utilities, telecoms, lack of secular growth. Don't want to be there. They don't have a long runway for growth, and it's unexciting. Limited pricing power is evident in mining, oil and gas, airlines, materials, and so forth. Don't want to be anywhere near that. People can make money there. I'm sure they will, and they have, but I don't want to hold it long term. Business cyclicality, which I don't like. It's very undesirable for me. Banks, shipping, tourism, steel, that kind of stuff, that's out. Capital intensity, that's very high and constantly in need of this capital. Heavy manufacturing industries, insurers, automobiles like Tesla, real estate, et cetera, et cetera, et cetera. Low returns on capitals as well in real estate. Also, I don't want anything to do with non-existent switching costs. I don't want fierce industry competition where there is no moat-like advantages. I don't want lack of diversification where people are selling or management is selling commoditized products. I don't want low barriers to entry. I want to subtract all of that. Now, keep in mind, some of these will overlap and so forth. And then, but by the way, if you just look at what I've been just talking about recently, and also a lot of these industries are notorious for value destruction. So if you think that I just don't want to own them, you just have to look at their track record, and you look at the amount of companies that they cut out of the index all the time that have destroyed value, and they constantly have to add new members. How many of them go bankrupt? These industries that like airlines that I've talked about, I mean, it's really unattractive, undesirable for me. Perhaps other people agree. Now, it's important to understand here that I'm not claiming that you can't make money in these unattractive industries. I just want to be really, really straightforward here. There are more than one way to skin the cat. And even the worst companies in the world can enjoy an extended rally from time to time. And, they can do well during some bull markets and so forth. All I'm saying is for every unit of risk that I take, I want to make sure that I have the highest possible chance of success. And chance is the layman's term for probabilistic analysis, probabilities. So I want to increase my chances. Odds are chances and payoffs, right? I'm not talking about just odds. I'm talking about chances. It's a very, very simple idea. And those are just qualitative factors I talked about. But if we go into the filtering work that you've done on that slide, I think more than 1/3 of S&P members have not grown their revenue by at least 3% over the last decade.
Yeah.
Okay?
Yeah.
And then a following reopening, which was severe, but a lot of businesses got cash flow from the government too. I'm not sure if I'm coming through. Said my internet's a bit unstable. Am I good?
No. I think we were lagging for a second there, but I can still hear you. Yeah.
Okay, great. On the other hand, a quarter of the index has grown revenues by double digits over the last decade. I want to know who did this, how they did this, why was it achieved, and whether it can continue. So that's where I'm going to do a deep dive. half of the index have not grown free cash flow by at least 5% over the last decade. Okay, some of these overlap, right? More than a third of them have either contracting free cash flows or no free cash flows at all, or no growth at all. And a third of them have a free cash flow margin below 8%. And some of them don't even generate free cash flow. So that's a lot of the index that's not doing really well.
Yeah.
Half of the index has inadequate return on capital. I'd say return on capital is 7% or lower. That's kind of what my benchmark. That means that they're not really. And meanwhile, we're living in a period of time where the cost of capital is increasing, mind you. If anyone looked at interest rates in the last 3 years, and here you have half of the S&P not creating any value, but destroying value, irrespective of whether they're growing or not growing. They're destroying value because their return on capital is lower than the cost of capital. On the other hand, 1/5 the S&P generates ROC of 15% or more. And once again, I want to know who did that, why was it achieved, and whether it can continue once again, right? Yeah. And then finally, when it comes to healthy balance sheet, meaning that the level of debt is a red flag for a disciplined investor, more than half of the index, I think, which you outlined, doesn't have a healthy balance sheet in one form or another, whichever way you kind of look at these metrics of value or ratios. So that for me excludes a large amount of the index that I really don't want to invest in.
Yeah. And if you combine these filters, it really reduces the investable universe if we just focus on the S&P here down to a very manageable number of stocks, right? But then you also have to keep in mind that just because, say, today you can't find anything interesting, it doesn't mean there won't be something interesting 6 months from now or tomorrow even, who knows?
But let's not forget that the S&P committee doesn't do anything that I just talked about. Yeah. And they don't do any filtering, and they beat 95% of the smartest people in the industry over 20 years and 90% over 10 years. And over 5 years, it's like 85%. In some cases, 75%, depends which one of these things you look at. So, it's the question that I have is, is the analytical edge still available, or has it been arbitraged away? And that's a rhetorical question, and one for everyone listening and for us as well to think about. But there is definitely a lot of the constituencies in the S&P that I don't want to own, and I think cutting them out, I can only improve that index. But the question remains whether I'll be able to outperform the S&P committee, because they run such a simpleton-like strategy, and it's a walk in the park against almost everyone.
Yeah.
So yeah,
awesome.